Stop scrolling. If you're thinking about selling a house with a reverse mortgage, or you just inherited one, this could save you thousands of dollars. Selling triggers something called a maturity event, and if you don't understand what that means, you could walk into closing completely unprepared. First, the big concept. When you sell a home with a reverse mortgage, that sale automatically triggers what's called a maturity event. That simply means the entire loan balance becomes due. But here's the good news. HECM reverse mortgages, the federally insured ones, have no prepayment penalties. Now let's talk about what you actually owe. It's not just the cash received, it's the principal, plus accumulated interest, plus monthly service fees, all compounded over time, and that balance increases every single month you wait, which means timing matters. Now here's the part most people stress about. What if the house is worth more than the loan? Simple. If your home sells for more than what's owed, you keep 100% of the remaining equity after closing costs. But what if you're underwater? What if the loan balance is higher than the home's value? Here's the protection. Reverse mortgages have something called a non-recourse clause. That means you, or your heirs, are not personally responsible for the difference. Pause. And here's where it gets powerful. The 95% rule. If the loan exceeds the value, the lender will accept 95% of the current appraised value as full payment. The remaining balance, covered by FHA mortgage insurance. That protection is huge. Now let's walk through this strategically. Contact your loan servicer immediately. You need an official payoff statement, not an estimate. This tells you whether you're walking away with equity or dealing with a short sale scenario. The appraisal. The lender will order their own appraisal, but you should also have your real estate agent run a comparative market analysis. Disclosure. You must notify the lender of your intent to sell. If the loan becomes due and payable, typically after death or moving into assisted living, you generally have 6 months to sell. As long as you're actively marketing the property, extensions are often granted. Closing. At closing, the title company pays the lender directly from the sale proceeds. It's handled through escrow. Here's where smart sellers win. First, interest impact. Because the interest compounds monthly, the longer you wait, the higher the balance climbs. Second, home condition. You're still required to maintain the property. If the home falls into serious disrepair, it can trigger foreclosure acceleration. Third, heirs. If you inherited the home, you have the same protections. You can sell, pay off the debt, and keep the difference. Or if it's underwater, you can allow a deed in lieu of foreclosure. That protection is federally backed. Let's balance this out. Pro tip: when hiring a real estate agent, ask if they've handled HECM transactions. HUD timelines are strict. Communication with reverse mortgage servicers is different. Selling a house with a reverse mortgage isn't complicated, but it is procedural. And if you understand the rules, protections, and timelines, you can walk away confident, and possibly with cash in your pocket. If you found this helpful, save it, because someone you know will need it.
Your ultimate hub for real estate insights, breaking news, entrepreneurial wisdom, investing strategies, and self-development hacks. If you're ready to expand your mind and stay ahead of the game floor, you're in the right place. Subscribe now. Your future self will thank you.